Coming up in today's video, stocks are a little bit lower, Bitcoin continues to lose ground, Ethereum's down 3%, is the dollar index due for a bigger bounce, and are we finally going to see the breakout I think a lot of us have been waiting for on gold prices as we reach the 5th time that we retest the previous all-time closing high. I'll of course update you on some of the trades that I am taking now and some that I'm watching, so stay tuned, let's get started. This morning we got PCE numbers out of the US, and the headline number was 2.6% compared to the forecast of 2.6%, and remained unchanged from the prior time at 2.6%. On the core PCE number, we saw a 2.9% compared to consensus of 2.9%, slightly higher than the prior number at 2.8. And this didn't really cause too much of a move on the dollar, but still shows in terms of where inflation is at. If we're talking about the core number being around 2.9%, this is still a good ways away from that 2% target. And the headline number being at 2.6%, again, still a good ways away from the 2% target the Federal Reserve has. So if inflation is still sticky, the Fed should just not cut rates and the dollar should fly, right? Well, before we jump to that conclusion, let's also take into consideration the other side of the Fed's dual mandate, which, to remind you, their dual mandate is maximum employment, meaning keeping people employed as much as possible, and price stability, aka unemployment and inflation. So we can see here in the JOLTS job openings data that the trend here is to the downside. And in a second, I'll tell you about how all of this impacts our charts. Because at the end of the day, the whole point of looking at this macro data is to help gauge whether it could lead to some sustainable trends in charts that we could make money from. Fundamentals are like the wind on the ocean for a sailor. You want to be aligned with the wind, not trying to fight it. So we see cooling economic data in terms of the jobs report, and just take a look at the NFP report. By the way, next week we get fresh NFP data, which could be really telling about this market. But we can see a considerable slowing in hiring in the United States, which is getting the Fed's attention on that other side of the mandate. Yes, inflation's a little sticky, but jobs data is worsening, and that is where you want to be really careful. Taking a look at Fed rate cut probabilities going out to September, we are still sitting at an 87 probability that the Fed is going to cut interest rates. Now again, yes, you've got inflation problems, but at the same time, you got jobs data problems. So the Fed is expected to cut interest rates by a little bit, not by a huge amount, by a little bit, to try and keep things stimulated on the jobs market side while we still fight inflation. We're now fighting on two fronts, essentially. Now, if you've been watching the channel, then you know that I've been talking about how I am bullish on metals in all of this and why I'm cautious on stocks. This concept of stagflation, aka the economy slowing while sticky inflation is still a problem, is a circumstance in which I think metals look really attractive. Because again, in this circumstance, people can get a little bit worried, especially if it continues to worsen, right? If we continue to see inflation risk and slowing growth, that could really scare people into potentially even having mistrust for what the Fed is going to do next and worried about it, right? So that dynamic leads me to a cautious positioning and a favoritism towards metals, which love chaos. Again, I'm not trying to make a big bet or, I'm not hoping that we get some sort of worsening in the labor data and all that sort of stuff. But to hedge my positioning as a trader, my goal is to look at the data and to align myself with the trends that I think are likely to take course. And I could be wrong, but that's why we are traders, right? We manage risk. We stop out of trades that are, wrong, or we manage risk as best we can. So my opinion was, and still is, that silver and gold look attractive in this environment. Now, I didn't come to this conclusion all in my head. I use software to help me spot these trends in the data. The top setups page is essentially an algorithm that looks at a bunch of economic data, technical data, and sentiment data to help generate bullish or bearish readings. And this page is for a very limited time over the weekend available for free on our website. If you want to check out the top setups page to explore how our algorithm works and how it looks at things like inflation, jobs data, growth metrics, seasonality, technical reads like momentum, and generates bullish and bearish readings, I encourage you to take advantage of the free version of the Edge Finder available on our website. Take a look down below in the description, and if you click that link, just fill out that form real quick and you can get access to the Edge Finder free version to explore this weekend and try it out. While the Edge Finder free version is limited, it's still a great way to explore the full list of products that we offer here at A1 Trading. So going back to the top status page, I do still really like the idea of being long silver, long gold, and short the dollar. And so what we can see here is that euro dollar is getting a bullish reading. That is a bearish dollar bet. Kiwi dollar, Aussie CAD, these things are getting some of our bullish readings, while bearish readings are things like CAD yen, Euro Swiss, dollar CAD, dollar ZAR, CAD Swiss, and dollar yen. And for those following along with the silver trade, I did update members. I did trim my stop loss slightly on this trade by reducing my risk. So here was the initial signal that I sent out when I sent this silver trade. I put the analysis into the chat room here, of course, where I share all of my trades, but then I actually updated yesterday that I was trimming my initial risk. So that initial stop loss was a little bit bigger. I ultimately decided after a really sharp rejection at that support level that I marked up to trim my risk, reducing the trade size. And I do this very often in my trades because I believe, again, I don't necessarily want to move my stop loss way up and hug price too closely, but I do want to reduce a little bit of the risk on my trade if I see a good price action ability to do so. And that rejection that we saw was a nice opportunity to just trim that stop and bring it up a little bit tighter. If I decide to do further adjustments to this trade, it will be updated within the signals room under the commodities trade section. I trade indices, commodities, Forex, stocks, and more. You also get access to Marco's trades and Ivan's trades as part of the group. And just a reminder from the announcement I made yesterday, the VIP signals sale is 40% off today and yesterday. So if you haven't taken advantage of it and you want to get access, send us a direct message using the first link in the description and just let them know you heard about the sale. It is a flash sale, so it's going away after today. So with my silver trade, my primary goal here is to see if we can get a break through the highs today. If we do get a closure above, I'm going to be taking this stop loss and trailing it as we've got a really nice reaction here. I know I'm looking at the SLV ETF. Of course, it is still silver. It's just another form of silver. You can still see the same idea. Nice rejection here from the bulls essentially holding this area, as well as kind of a fake breakout here to the downside. We'll see what price action does for the rest of the day, but if we can close back through these highs, I'm going to trail a stop tighter. And gold is really, really close to breaking out to a fresh high. Maybe by the time you see this video, depending on what's happening, we may have seen a fresh closing high on gold. It's been quite some time where gold has been consolidating and finally looks like it might have legs to run here and break higher. Again, the last few weeks, we've been getting really strong bullish readings on the metals, and I do think there's some upside here. Let's also take a look at the euro dollar position that I'm currently in. This one's not nearly as exciting, but I did buy some euro dollar with the idea of buying around 1.16. I'm also willing to add a little bit more to the trade if we do go down to 1.14. But I think that the euro dollar is likely to make a push back towards those prior highs. I am bullish on it for now. And as I record here, the stock market is getting a little bit sold off here. Got NASDAQ down just shy of 1% this morning, down 0.92%, S&P 500 down 0.5%, and gold and silver holding up. Again, this is what I'm kind of betting on right now, is essentially I've raised cash, sold some stocks that I own, and have moved money into silver in my personal portfolio. That stagflation risk that I talked about earlier still remains for me and just makes stocks just vastly less attractive than something like metals. And speaking of stock indices on the higher time frames, I just think that we have room. Someone actually kind of got mad at me in the comment section and said, you've been calling for a bearish move in stocks for months. And I do want to just clarify, while I have, to their credit, been cautious on stocks, I'm not short the market and I'm not making the bet that I think stocks are going to make a big push lower. If I was truly convicted about that, I would be telling you guys that I'm short, but this thing is still in an uptrend. We're in a bull market and I don't short markets that are in bull markets like this. Like, again, it's a very hard trade to try and time stocks like that. Rather, my approach to being cautious on stocks is just to hold cash, like raise cash, trade other things, look at other markets and just kind of be preoccupied in other places. In the meantime, yeah, I would welcome a pullback in stocks, at which point I could potentially get some trades back on if the data comes in a little bit better. But I'm not really paying too much attention to the indices at this time in terms of actively placing any trades. Of course, I watch them every day, but I just want to clarify that. Yes, I have been early to the idea of thinking that stocks could pull back, but I have not been trying to time this in the form of any sort of positioning. The closest argument you could say in terms of actual actions that I've taken is I have sold some stocks, but I'm still very heavily invested in companies that I really like for the long term on an individual stock level, and I've placed no trades in terms of active index trades. I'm not short, I'm not long. Let's take a look at some sentiment indicators around the stock market right now, which can be a really big indicator for the rest of the market, even if you don't trade indices. Taking a look here, we have the AAII Investor Sentiment Survey. This is a weekly published report that helps us get an idea of what crowd sentiment on the stock market is each week. And what you can see here is that people have been slightly rising on the bullish front. I actually made some extra charts on this just to help show this. Bullish sentiment has kind of topped out, come down, and is now sort of on the rise again. The exact opposite for bearishness. We saw a spike in bearishness and then have been rolling back over. I would still say, though, when we look at this, that there is still a good bit of bears in the room. That makes me a little bit cautious to make a big decision one way or the other. If we know, generally the investor sentiment surveys, they lean bullish, as most of the time markets go up and most investors kind of lean bullish. I would still argue that this is a pretty heavy bearish exposure in terms of crowd sentiment. So, even at 39.4%, last week it was 45%, 46%. So we are slightly less bearish, but we still have bears in the room. And so that tells me that on pullbacks, there's still room for bears to kind of get smashed and for this market to keep moving higher. So again, that's where I'm not trying to time the top on this thing. I just think the risk to reward is better in other places, like specifically gold and silver. And just as a side note, even individual stocks, there are some that I think are more attractive than others. If you want to see more about stocks that I actually like, specifically, I've been looking at healthcare names and some of the more defensive stocks out there. I talk a lot about this on my second YouTube channel, Trader Nick Stocks. Here's a look at the put to call ratio, which shows you the options call and put volume. Helps us to get an idea of how crowd sentiment is feeling about the markets. Of course, we can select a lot of different things in the top right. If you want to look at put to call ratio for gold, for NASDAQ, Nikkei, Russell, we have a good selection up here. And what we'll see here is that currently we're still in sort of a neutral territory. If this thing gets extreme one way, if it goes very high, what that's telling you is there's a huge demand for puts, people are bearish. And if it goes very low, there's a huge demand for calls. Interestingly, right at the top of the market, we did see a huge spike in call demand. And so often this is what we see. When the market gets really euphoric, the market turns around. When everyone gets really, scared, the market turns around the other way. So really interesting, and put to call ratio is still probably my favorite indicator when it comes to risk sentiment, or market sentiment, I should say. Here's a look at the Bitcoin to gold ratio, which is another indicator of market sentiment. What we have seen is sort of a rolling over in risk sentiment. So you can actually see this moving average moving lower. What this is telling you guys is it's telling you that gold is outperforming relative to Bitcoin, right? So what that's telling you is that gold versus Bitcoin is gold is winning when this thing is going down. Bitcoin is winning when this thing's going up. It's a really simple indicator, but amazingly, it can be quite useful in spotting directional kind of sentiment trends. And so what I think we're seeing here is more cautiousness coming into the market, which could be a sustainable trend for a few weeks, in my personal opinion. This also marries up nicely with my positioning in a short dollar position, a long silver position. I also have a TLT trade that I'll show you guys, which is bonds, and also some defensive stocks. So my positioning is very conservative, very sort of risk off oriented at this time, which is not necessarily, the crowd sentiment. Which is of course sort of a posture that would favor markets pulling back a little bit. And I still kind of stand by that. I really like the idea of keeping cash on the sidelines, and I'll show you more of my positioning. What you're looking at here is TLT. This is a 20+ year treasury bond ETF. And I did a bullish options trade, essentially a short put trade, thinking that we could have some upside and that rate cuts, I think, are still coming down the pipeline. Otherwise, I probably wouldn't be long metals and bullish on TLT. But the reason I'm not overtly bullish stocks with the idea of rate cuts coming is because I think that you're getting rate cuts in tandem with also some sticky inflation, but really the rate cuts are coming because I think that labor data is suggesting it's time to cut rates, which is a concern to risk assets. Let me also be very transparent that my account is still very positioned long risk on stuff. So this is where that comment about saying, Nick, you've been calling for a top, I'm definitely not, because my account is telling me that on a down day, my account is also down too, right? When I say down day, I'm talking about the NASDAQ, right? So the NASDAQ is down about 0.92%. And as I just got done showing you, my account is down 0.45% at the time of recording. So it's a down day for me. But my point is I am down a little bit less than the NASDAQ here because of some of the risk off positioning that I have. So about a week and a half ago, I talked about a VIX trade that I took. which is a bet, a call vertical spread without getting too complex with the options. Basically, it's a bullish bet that I think that the VIX will have some sort of a spike between now and November 19th. However, with options, there is such thing as time decay, meaning you essentially over time lose value on your options. So you have to be right, but you also have to be right in your timing. If we do see a sharp spike in the VIX, this trade may be a profitable one, but currently we're sitting in a losing position so far. By the way, the brokerage platform that I'm using will be linked in the description down below. It's Webull, and they offer my subscribers some special offerings if you check out the link there. And today's video is sponsored by DNA Funded. If your goal is to get funded this year, then check out today's sponsor because they have some really cool offerings for my subscribers. First of all, the promo code that you see right here, 20% off with promo code A1T20. Write that down, and at checkout, make sure to apply that to get a nice discount. With DNA Funded, they offer payouts in as low as 7 days. You can trade pretty much anything on this through their CFD platform, whether you trade Forex, indices, commodities, everything they have pretty much in their CFD platform. They also offer unlimited trading days on both their 1 and 2 phase challenges, which can be great for swing traders. They finally offer profit sharing up to 90%. So if you are at a point, and I say this carefully, if you are actually at the point where you are ready to get funded, you have some consistency in your trading and you're ready to scale up, check out today's video sponsor, DNA Funded, down below in the description, and make sure to use that promo code to take advantage of the 20% off offer they're making to my subscribers. In today's podcast episode with Johnny Hart, we discussed a little bit more about the state of the economy. Check out this clip.
It's funny, Nick, how these conversations seem to ebb and flow every few weeks, because 1 minute we're saying, well, just maybe 1 or 2 more cuts this year. Now you're veering towards 3. I mean, it's a very reactive science, this, isn't it, really? I mean, is it a science? I suppose it is. It's economics. But it does make one a little bit cynical, because, you know, you think to yourself, we kind of know where we are, but we don't really, do we? Let's be honest.
That's right. And comparing it to a science it's funny, because economics in general, when trying to predict what the Fed's going to do, or rather what the Fed is thinking to do themselves, the challenge that they have that perhaps is different than like biology or chemistry or something is that this science involves trying to predict the future, and the future is really difficult to do, right? Because you can have something like, you know, maybe Putin decides to change up his tone on Ukraine, or maybe you have oil prices shoot up, or maybe China and the US get into it again. Like, there's all these dynamics that are very difficult to sort of predict, and the Fed kind of has to weigh its options. I think that if the Fed is being data dependent, as they have kind of claimed, that is taking the rear view mirror approach. You're saying, I'm going to look at the data as it's come in, and I'm going to make decisions going forward based on what I see in the past. There's pros and cons to doing that. The pros, major pros of being data dependent, which I think the Fed probably should be, because predicting the future is so hard, is, you know, the advantage of that is just say, okay, whatever the data shows, that's how we're going to adjust. But making these predictions, which has, you know, caused the White House to be all up in arms, right? Oh, tariff inflation is going to do this, or, you know, making these sorts of predictions, or back in the COVID days when, you know, we called, or Jerome Powell called inflation transitory. Those predictive measurements can be very, very difficult. And if you are wrong, it can punish you pretty bad in terms of what it can do to the economy. And I should say it can punish all of us pretty bad if inflation gets out of hand, or labor data really slides. So something to think about is, of course, you know, that data dependency approach, I do think is the safer route for the Fed. Of course, there's criticisms of that too, which is, you know, you're not looking ahead of you, you're looking behind you. So pros and cons to everything. I also just wanted to make a quick mention to yesterday's data points. Since we've talked, we did get the preliminary GDP numbers, which came in better than expected at 3.3% compared to the forecast of 3.1%. So that's their GDP revisions quarter over quarter, which were a positive revision. So we look a little bit better there. Unemployment claims also came in pretty much in line with expectations, so nothing flaring up too much on that side as well. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.